Hello guys, it's Chris from the tradingexchange.co.uk, and this is the third video in our series for our training course, and we're going to take a look at the Stochastic Oscillator. I'll get my teeth in there to try and pronounce the word Stochastic Indicator. There we go. Okay, so this is another technical oscillator, and this is specifically designed, this video, for traders that are spread betting or CFD trading on either Forex, indices and commodities. It assumes you've got a bit of an understanding of things like support and resistance, and the previous videos that we've looked at as well. And this will give you a better understanding of how to use Stochastic, how to choose the settings, how to look at some signals from Stochastic, specifically one of my most favoured signals, which is Divergence, and a couple of the drawbacks and a simple strategy that you can use. Alright, so let's get started. So as normal with these videos, we're talking about trading on margin. That carries a significant risk. Trading financial markets is risky. It involves the risk of losing all of our invested money. We're not providing financial advice on the site or during these videos. This is for educational purposes only. So please use the information at your own risk. Okay. So as you may or may not know, depending if you've watched a few of the videos already, I love starting with the German DAX as a market. It's my favourite personal market to trade. But this particular indicator will work on any market, on any time frame. So we'll look at a few examples and not just stick to the one market here. Okay then, so a bit of an introduction. Now the technical analysis tool Stochastic Indicator, let me just bring one up. For the purpose of the video, let's just bring up a basic one. Alright. The stochastic oscillator, stochastic indicator, should I say, is an oscillator. It helps determine when a market is overbought or oversold. And it checks if the buying or the selling pressure is running out of steam, excuse me, suggesting a reversal. And this can help us time a trading opportunity. The best time to use the indicator is when you're in a trend. I know I've said this quite a few times in previous videos. So the best time to use it is when you're in a trend and price has either pulled back to support or rallied up to resistance. And you can use various types of support and resistance. You can use indicators or lines, trend lines, horizontal lines, whatever you want to do. So the trend of the particular market in front of us here is bearish. Okay, we're looking on a 30-minute chart, but it's zoomed out to kind of mid-December last year. And I've put a stochastic indicator on here that's been plotted. Now these indicators they range between 0 and 100, with the value of 100 considered overbought and the value of 0 considered oversold. So when price is nearer to 100, it's considered oversold, meaning that the probability, overbought, should I say, nearer to 100, which means the probability of a decline is much, much higher. And when the price is nearer to 0, we're oversold, so the probability of a rally is much more likely. Now this indicator highlights zones. So the zone of 0 to 20 is considered the oversold zone, and 80 to 100 is considered the overbought zone or region. In an uptrend, you want to buy from the oversold level, and in a downtrend you want to sell from the overbought region or zone. Okay? As you're entering a trade after the move, which is what these particular indicators are doing, they're kind of lagging if you like, you can use the recent swings to set your stop losses. Okay, so that's looking a little bit further advanced, but just helps you get an understanding of how you might be able to use this in your trading. Okay, and a simple trading strategy for this particular oscillator would be to wait for there to be a cross of the two different lines. similar to MACD that there was before. Okay. So we've got a MACD line, MACD. We've got a stochastics line in front of us here, which we can see some signals on. But I have been looking through a few of these already, and I've noticed a selling signal already. Okay, so here we go. Here's just zooming into a German DAX for January 2016, just giving you an example of a couple of selling signals. So here we have used a stochastic oscillator. We know that we're in a bearish market, so we're looking for selling signals. So we're looking for points where the lines are crossing in the direction of the trend from the overbought zone, okay, which would in this example have been here. So if we would have got in this little area, let's say, we would have sold, we would have put our protective stop loss above the swing and gone for a risk reward ratio of 2 times the money. Another example here, the line crossed below, we're in a downtrend, it's in the overbought zone, that's the signal to enter. You'd put your stop loss above the swing and you'd go for 2 times the money. Now you've also had a buy signal here because the price crossed above. It would have turned out to be quite a good trade, but we would not have taken that signal because we're in a bearish market. Not interested in buying signals in a bearish market, only selling signals. Turns out there was another one here as well. Okay, that we know now has turned out really well because we're around about 8,800 at the moment on the DAX. So on the stochastic oscillator, you've got 2 different lines. I'm going to zoom in to show those lines in a bit more detail. You have what's called a K line and a D line. And you're looking for those to cross over. We'll go through those in a bit more detail. So it's very, very similar to the MACD, is the stochastic indicator, in that, first of all, the trend will be your friend. Follow the trend to trade. And I'll repeat myself here. The basic premise of my personal trading, which I recommend to anybody, is to follow the trend. Only trade in the direction of the market. Sorry to labour on that point, but it's really important. Some traders do like to do a counter trend strategy and trade in the opposite direction of a trend, but that's just not the way I do it personally. And I would recommend you not either. Okay, so in the previous articles for MACD, we discussed the 2 different moving averages that combine to create signals, and you enter into trades on the crosses, which we briefly looked at as well. Now, there are 2 types of stochastic indicator. There's a fast one and a slow one. And the difference between the 2 will be these settings. Okay, so when you load up a stochastics indicator, you'll generally need to choose 3 numbers. You've got your percentage K, your percentage D slowing, and your percentage D periods. And you normally read it in this sort of order, 5, 3, 3. Okay, now that would be considered a fast stochastics. One I tend to personally prefer to use is 15, 5, and 5. Which is a slow stochastic oscillator. I actually just realised as well that this is in a slightly different order. The numbers 15, 5 and 5 would normally be that one, then that one, and then that one. 15, 5, and then 5. Okay, so 15, 5 and 5 is what I tend to use. And you'll notice now, as you can see, at the oscillator at the moment, we're on a 5, 3 and 3. And there are quite a few signals here, sell signal, perhaps a sell signal, so on and so on. But when you apply the 15, 5 and 5, it will smooth that out even more. So depending on your personal preference, in fact, I'll just include another one, just to show you the difference. There we go. Depending on your personal preference and how many signals you want to get in a day or a week or a month, you might want to vary the settings on your stochastics to give you more or less signals. A faster stochastics will give you a lot more signals, but the accuracy of those signals might be a lot lower. A slower stochastic will certainly give you a lot less signals, but the quality of those signals will allow you to leave your trades running for much longer and potentially earn you a lot more money. And the settings on the stochastics, they can seem quite confusing on the front of it, but just try and think of them as three different numbers. And so the percentage K, that's the kind of the raw stochastic value. It's the kind of key number. This percentage D is going to be effectively a moving average of K, similar to MACD. So it's like your signal line. And to confuse things even more, this slowing one is a moving average of that one. So it's been a little bit unusual. So that's a moving average of that, and then that's a moving average of that. So it's like a moving average of a moving average of a moving average, almost. And that's how they would work. So they will simply provide you with the two lines which oscillate between two zones. And the simple way of trading them is to trade a crossover in the direction of your trend when it's in the either overbought zone or the oversold zone. Okay, so you'd have, on a faster stochastic, you would have traded there, there, maybe there, possibly there, here, there, there. You could have done all of them if you wanted to. In a real life situation, we've kind of missed the opportunity to trade this one right now. We're heading towards oversold now. So what you would probably want to wait to do is to see something like this, where you get a bit of a pullback and you see the oscillators come up here, and then you can sell as they cross back down again. So you'd want to get in, for argument's sake, around there. And that sort of ties in with the fact that we had resistance up here. Let's say it was there. So if you get a crossover near resistance, it makes the signal a lot stronger. Okay. Right, so moving on a little bit more advanced to apply with stochastics. One of my more favoured signals that you can find to trade stochastics is something called divergence. I've just noticed a pop lower on this one. Really good opportunity to sell this market, but no, must not. I'll do it later. Okay, so divergence. We talked about it briefly with MACD in the previous video, and whilst this chart picture in front of us here might look complicated, I'll try and explain it as we go along. So the first opportunity to trade this, we're looking at a chart of the DAX from last year, 2015, when we were in a strong rally between February and March. And so we've identified the trend as bullish, which means we only want to be buying. Okay, so we're looking for opportunities where prices come down into the oversold zone. We've found a cross and we want to buy. So that happened here, around about this area right there. Price came into oversold, crossed, so we would have entered. And it would have been around about this blue candle here. So we waited for that blue candle to close, and then we entered to go long. And the rule is, whenever you go long, you set your stop loss, protective stop loss, under the most recent low, certainly when you're buying. If you were selling, you'd do it the opposite way. Put your stop loss above the high. Anyway, so we would have entered on the close of this blue candle and the start of this, what turned out to be a red candle, and we would have gone long. Stop loss here, and that's risking 50 points. Okay, so double that to find your profit target, makes it 100 points up here somewhere. And we want price to go up there to reach our target. Now, it turns out it didn't. We were stopped out on this trade. Price came back, took out our stop loss. We're out of the trade we lost. Not a problem. Now, price made a lower low, but the oscillator made a higher low, and this divergence between the oscillator and the price creates positive divergence, which is a brilliant signal, especially when it's right next to a point of support, which in this case was a bullish trend channel. So it briefly pierced it, came back up, created a candlestick formation, which is interesting, which is like a hammer or a pin. And that gives us our signal to enter on the close of that candle. I think it was a little bit later than that, actually. It was probably around about this candle here. Or for argument's sake, even this one right there. Okay, so we're waiting for a break above this. So we entered on the start of this blue candle here. And we risk 80 points, put our stop loss below this one here, and we go for 160 points in return. And in this case, as you can see, we won the second trade. So we only won one of the two trades, but we actually won 160 points on the second trade after losing 50 points on the first trade. So total profit, 110 points. You know, £10 a point, or I don't know what you're trading, £1 a point, 50p a point, 10p a point. It doesn't really matter. You'd be in profit. Okay. So that's positive divergence. Let's find another example. Haven't got the first trade loss, but it just gives you an example here. Price came down to here. We had a cross. I suppose we could have entered the trade on this blue candle here. Risk would be the stop loss under here. You'd want twice that. Started making a bit of a profit, but reversed, stopped us out. We lost the trade. We created a lower low on price, but a higher low on the indicator. And that then led to another trade opportunity. So we could have gone long here, risk underneath that, and up we go. Okay, so that's positive divergence. It works the same way in reverse, negative divergence as well. So this is also a chart of the German DAX, but it's more recently, in July last year. And we identified, for one way or another, that we were bearish. Okay, we've been falling, and we wanted to look for selling opportunities. So we found one here, where we got up to 11,750-ish, 11,800 towards. Found a signal where we were crossing in this zone. Took the trade, went short, got stopped out, basically, and price made a higher high, the indicator made a lower high, and that difference created negative divergence. So on the second trade entry, we did really, really well. And another example, again, negative divergence. So price created a higher high, the indicator created a lower high, and this actually led to an 800 pip move. So you'd have been doing quite well there, because you could have added to the position here, 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 and you would have just, well, you'd have made a pretty good month. You know, in a pretty dismal December, you'd have done really well. So divergence create fantastic trading opportunities. Okay, let's clean this chart up. Okay, the final thing that you can be aware of for stochastics are the drawbacks for the indicator. Now, the drawbacks are that stochastics are not quite as reliable as MACD in terms of accuracy of the signals. Okay, you're going to get quite a lot of them. It provides a high volume of signals, but they're very timely, so they are acting quite a lot faster than the MACDs will act. So they're not particularly accurate, but you're going to get them faster. So I think using them with MACD is also a good idea. If you're getting signals on both, you know, the stochastics can make you then look at the MACD to enable you to provide some confirmation. So the stochastics on its own is not a great standalone indicator. It often needs another form of confirmation before you can really rely on the quality of its signal. So to use it properly, you need to have some ability reading the charts and be comfortable plotting support and resistance. And that's essential. Otherwise, you're just going to receive constant false signals. You'll never feel confident with it. You'll start losing money. You'll lose confidence in your own ability, and it just gets you in a bit of a mess. So it's a tool. You can't rely on it on its own. You should use it with something else as well. All right, and we're just going to look at a fairly basic, simple stochastic indicator trading strategy, and that'll wrap up the video for us today. So let's go and take a look at a daily chart, and we're going to just pull the German DAX just because it's there. We're going to put a simple 200 period moving average on the chart. Don't care about the colour. There it is. And we want to understand the underlying trend of the market. Well, we're trading below the 200 period moving average, so we're bearish. Pretty crude, but let's just go with that. So we only want to be looking for selling signals. Okay? So we want to be looking for some selling criteria. So the daily chart is bearish. Let's go down to the, let's look at the hourly chart. We're going to apply a slow stochastic indicator of 15, 5, and 5. There we go. Now the market must be oversold. Sorry, let me start that again. Must be in the overbought signal zone. So that would have been here. Can't actually draw that. So I'll draw a line. There. That's where we had the cross. Let's say we were a candle late and we didn't get into there. That's where we're trading. On the close of that candle, we short the market. We put our stop loss above the recent high, which would have been up there. How much are we risking? 139, 140 points. And with that in mind, we're then just going to sell. And we're going to aim for 280 points. And in actual fact, this particular move is still going for 890 points. At £10 a point, you've had a good week. Or pound a point, or whatever it is you're trading. Whatever your volumes are. And that's just on one trade. Really simple. You could even have traded, if you were really aggressive, because a conservative trader would only be looking to sell in this oversold zone. So there are not many signals. In fact, in the whole month of February, you've had one signal. And you'd have to sit on it for, well, until now and continue. You'd be doing very well, but you've got to have the nerve to sit on it when the market starts to move or looks to be moving against you. So another example is you could take that first trade and then you could add to it on subsequent crosses. So you'd have another one here. So let's say you got in late and you didn't get in until the end of this candle. So you're already in this trade, so I'll keep that one there. Well, actually, no, because it'll just get messy. So you got in here. You put your stop loss above that high. You're now risking another 180 points, so you're going for 360 as a profit. We would have just missed it on that little low, but you would have caught it down here. And you'd still be riding that. There's another 800 points. Happy days. £10 a point. Another 8 grand. And you then could have done another one here. On that cross below there. Let's say you didn't get in till there. Which is a bit late. A couple of candles later. You could get in earlier than that, but let's say you didn't. Put your stop above here. 220 point risk this time, well 225, so 450 point profit you're after. Again, you'd have hit that. £10 a point, 4.5 grand. So far you've done pretty well on 3 trades. You've just traded the crosses. There's another opportunity there. I mean, you can. The examples will just continue. All right, let's say that was the cross. Let's say you didn't get until 2 candles later. Let's say you didn't get until there on the bottom of this candle or whatever. Put your stop loss up here. And you can see yourself, you're risking probably 210, 200 points. You want 400 point return. And you would have just clipped that. Happy days. Great week. Go on holiday. Buy a car. Great. What a job. And it can be that simple. and that's just in a selling opportunity. Let's just take a look at a buying opportunity. So I don't know, let's have a look at the dollar CAD. On the daily chart, we are above the 200-day EMA, so we only want to look to buy. So we go down to the hour chart. We apply the 15, 5 and 5 stochastic, and we want all the periods where it's going to cross above the line. Some of these may not be brilliant examples, but it gives you an idea at least. So we want to be looking from the overbought zone, which is here. Now in the DAX, every single trade seemed to work out. In this particular example, it might not. So where do we get in here? Let's have a look. We had the cross. Let's move over there. Sorry if that's playing with your eyesight. Okay, so this was the cross here. So it was the end of that candle. So we would have entered about there. Stop loss below these lows. 2 to 1. We're risking, I can see already we would have missed this. 45 points, so we want 90. We missed. Turned around, hit our stop loss, and we got stopped out. But you'll notice lower low, higher low, divergence gives you another signal to get into that trade when you have a cross, which was here. So you get in about there on that blue candle. You're risking 60 points and you would have hit 120. So previous trade you would have lost 45 points. This one you would have won 130. I mean, it's really simple stuff, and it can be really, really effective to trade it. But you've just got to follow that trend. And if you can follow the trend, in fact, there's another example right here. I could just see you would have had a cross about here, or there in fact. So here, you would have gone long, stop loss, got stopped out. A lower low was created, but a higher low was created. Divergence led you to another trade opportunity to go long, which you would have hit, and it would have done very well for you. So hopefully that helps you guys. That gives you an idea of how you can use the Stochastic Indicator, get my teeth in, to provide you with opportunities to get long or short in a market. And applying these simple trend following strategies, ABC trading, will allow you to make money, providing you're happy to sit on the trades for, you know, maybe a few hours, few days, even a week or so, if you really want to go for it. So best of luck trading. Feel free to apply that to various time frames, you know, not just the hour, but maybe the half an hour or the 10 minutes, 5 minutes. See if it works for you there. But wish you the best of luck in your trading. Come and join us in the live webinars and the trading rooms to use these strategies in real time, to come and learn from us as well. And we hope to see you around soon. Best of luck trading, guys.